Welcome back, everybody, to what is likely and widely expected to be the least surprising Bank of Canada announcement in a long time. For the first time since 2020, the Bank of Canada dropped the overnight rate by a quarter point for a third consecutive time. Now, this signifies a significant change from the Bank of Canada's tone, and although many were already predicting rates to come down, we'll talk about that in a later point in this video, it still puts things into perspective of where we are right now and where we have yet to go. Prior to the Bank of Canada's announcement today, there was, even believe it or not, about a 22% chance that they were going to reduce rates by 0.5%, with a lot of the economists out there from the bank suggesting this was very likely to happen. And while it didn't happen, there's a lot of people out there still proposing rates are going to come down fast and furious. But before we get into it, let's cover all the key details that you need to know and what you should be expecting to do in the near future. Oh, by the way, I'm Alex McFadyen, the owner at Flow Mortgage Co. And if you haven't done so already and you're watching this on YouTube, hit that like button, subscribe, because it helps us to get reach more people to share this information. So let's get into it, and I hope you don't mind. I'm going to read a few details here as all this information has been coming fast and furious. So let's start off September 4th, today. If you're watching this at another time, then that was the date that the Bank of Canada decided to cut rates by a quarter percent, which could have a huge impact on the market. And a lot of the reasons for that right now is, as we mentioned, this is the third consecutive rate drop since the last one occurred in July of 2024, which is going to reduce monthly payments for all those variable rate holders that are out there and line of credit holders who are rejoicing behind the scenes, being grateful and thankful for rates coming down, but they wish it would come down faster than we were. Now, one of the things that was underreported about today's series of events was that in the United States, there was a U.S. jobs report, and it specifically noted that the job openings fell to 7.6 million, down from 8.1 million expectations, which is the lowest since January 2021. Now, if you don't know already, what happens in the US impacts us here in Canada, and this signals a weakness in the US employment economy, which is one of the key indicators of where rates are going to go and the overall economy's strength as a whole. Well, why exactly did this happen? Now, TIFF came out and publicly stated that, well, it's a combination of factors. Inflation is now at 2.5%, which is close to the target of where they want to go. They didn't say this explicitly, but one of the big reasons they probably didn't cut rates 0.5% is because there's still a lot of pressures on housing and services. Well, no surprise, housing pressures is high, interest rates are high. So of course the cost of housing is still going to be high. So is that a self-fulfilling prophecy? Maybe, we think so, but regardless, that's where we are right now, and that's what they were saying. Now, in terms of the services, costs are still high, but likely to start coming down over time, as it just takes time for these things to adjust and adapt as people are spending less money on services over the coming next months and years. Now, the BoC publicly stated that they're trying to manage weakness in the economy too, and they noted that they're trying to basically fall on this balancing act right now between should we go ahead and reduce interest rates more and threaten the possibility of inflating things back up again, or are we reducing rates fast enough, giving us the opportunity to ensure that we don't have an economic disaster? And that's really the fine line that they're trying to toe right now, and that's basically what TIFF was talking about in its presentation today. So looking forward, what could happen in the rate market and what are some of the expectations is really one of the questions that most people are really wondering right now. Now, whether you have a variable rate or you're betting on the housing market or you're just genuinely interested on the sidelines to see what actually happens, a lot of economists have come out and provided their predictions on what could occur and specifically where rates could be going in the near future. Now, starting off, most of the markets are pricing at least a quarter point rate cut in October of the 2023 meeting, with an 89% chance of that actually happening. However, if the jobs data disappoints, this number could go up and we could see rates actually go up to a 50 basis point drop, which is what we were expecting for September. And there are a lot of people who are pretty set on that actually happening at this point right now. In fact, some of the economists came out already today and let us know that their anticipation is by the end of 2025, rates will be down 75 basis points. And with only 2 more meetings before the end of the year, there's a very good chance that they could be right, especially if there's a 50 basis point cut in October, followed by a 25 basis point cut in December. Now, another thing to note about that is the bets on the US Fed dropping rates by 0.5% just bumped up again today amid a lot of this US news. And if they start reducing rates at a higher percentage, then definitely that impact is going to come back to and be felt here in Canada more than anything else. And if you haven't been paying attention to it already, oil prices have taken a beating too. Oil prices are down, which also indicates a little bit more of an economic recession globally speaking. All right, so really, what does this mean for you is the question that most people are actually asking. So, I mean, first and foremost, if you have a variable rate mortgage today and you have an adjustable payment, which is where the payments fluctuate, you're going to see your payments go down roughly $15 for every $100,000. This depends on your amortization and a few other factors, but that's approximately what you're looking at today. If you have a fixed payment mortgage, one of the biggest questions I've been asking for people is, for those who decided to increase their payment to the maximum, can I start now decreasing that payment? And the answer to that question is yes. If you increased your fixed payment to the highest amount to get your amortization on track when rates were at their peak, you can go back to your bank and request a payment reduction to reduce your monthly payment. And you'll continue to see, if you keep your payments the same, a reduced amount of interest paid with a higher amount of principal paid. Now, what people are looking at right now who are getting into the housing market is, does it make more sense to go fixed or variable? And with a slight dip in the bond yields here today, more people are wondering, should I go fixed with the certainty, with fixed rates being almost 1% lower than variable rates? Now, if you run an amortization simulation right now on a 1 year versus a 5 year, 2 versus 5, 3 versus 5, and that's fixed versus variable, variable rates basically come ahead in virtually every single simulation based on the assumption that they're going to go down to the overnight rate of 2.5%, which is basically what every single market is predicting at this point right now. And so the question mark for most people is, do I take that certainty when rates are going down, or I start higher with a variable rate and watch the market come down? And that's really up to you, and you need to understand your financial plan. But the biggest thing to keep in mind is that qualifications still haven't necessarily changed, with fixed rate qualifications still being higher than variable rates because of the stress test. And what that basically means is, if you want to get the max amount of money, you still have to take a fixed rate today to qualify for more, although that gap is starting to close more and more and more. And if rates continue to come down that 75 points by Christmas time, it's very likely that we could see fixed rates and variable rates on par, with variable rates starting to take the lead. Now, speaking of fixed rates, what happened today is the bond yields reacted with about a 6 to 8 basis point reduction immediately. And this indicates a little bit of a softening in the bond market, which could impact fixed rates. But if you look at a chart over the last 3 months, fixed rates have basically hovered around the same for the last 30 days, up and down. And so it's very unlikely that we'll see the banks react, especially due to the fact that RBC recently came out a report and explained that their profit margins had been the lowest that we've seen in a long time. Many are suggesting that even though there's rate wars at this point right now, a lot of the banks are going to hold steady until they see the bond yields start to slide more and more and more. And so really the next question is, how does this impact the housing market? And what are we going to see in the real estate market? Now, depending on who you believe and where you're looking and what type of market you're looking in, most suggest that we've now seen the bottom of virtually all markets, with the exception of a few like the Toronto condo market and a few around that type of region. Now, although we know that the assignment market and the new development market for condos is a little bit weak right now, actually very weak depending on where you're looking, there are a lot of different municipalities and cities across the country of Canada which are actually seeing a significant surge, especially in the last few weeks, in terms of offers and interest in the marketplace. Now, I can only speak anecdotally and the data that we're seeing right now, but the BC Real Estate Market Association has advised us they anticipate that house prices will start to rebound and increase modestly around 2.5% to 3% for the course of the rest of the year. And what I've noticed is that virtually everything that's entry level or mid level is starting to see more action right now. Action in the way of multiple offers and getting sold in shorter turnaround times. Now, supply is still really high, so from a buyer's perspective, that's a really good thing to see, and it gives you still an opportunity to get financing conditions and negotiate on price points. And we don't expect multiple offers on everything anytime soon, but it does actually show that it's a little bit more of a healthy market from a buyer and a seller's perspective. And for those looking to quote unquote cash in, well, you're probably going to be waiting a little bit longer if you're hoping prices to rebound from 2022 anytime soon, but it is very likely by sometime in mid 2025 that this turnaround will have taken place in most communities across the country. Remember, you need to speak to somebody who's actually analyzing this in the area that you're looking to purchase. Now, what's on deck here and what can you expect in the dates and key information going forward? Well, let's start off really quickly. The next BoC meeting is October 23rd of 2024, with an anticipation of a quarter to a half point cut. We've got the US Federal Reserve meeting, which is a big one, right up on September 18th, 2024, and that is a big one to watch out for. There are quite a few other key dates that you need to look out for on the next schedule, and it's going to be a really interesting roller coaster over the Q4 of 2024, and we'll see how obviously this impacts the real estate market and the lending market as a whole. With so many renewals coming up, a lot of people are wondering if rates are going to come down enough that they can feel that relief by the time their 2025 or 2026 renewal comes out. Now, we've got some strategies on that we'll talk about in a future video, so make sure to hit that subscribe button if you haven't done so already. And in the meantime, let's enjoy this quarter point rate drop from the Bank of Canada and watch and wait and see what happens.